All right. Welcome back to GrowthLab Jump. I'm Stephen Byler.
Dan Gertrudes.
Thought we'd get a little theme music going on this week for those who are familiar.
What do you got?
Some crisscross jump.
Nice shot.
Now that we've got that out of the way, you can see that I'm hip to the hop. Today we're June 22nd. We're looking at two things today for your GrowthLab Jump to jumpstart your week. The two things we're looking at today, one deals with the PPP loan application process. Now I have two applications. We'll walk you through which one is best for you based on the criteria. And then we're going to dive into a deep dive into one of the GrowthLab Four, which is understanding your cash flow. And I know we've talked a lot about cash since over the last 3 months on this event, but there's a reason for that.
So are we talking cash first or PPP loan forgiveness application first?
We're going to talk PPP loan application first.
Good.
So this is our little agenda for today. We are going to talk PPP forgiveness, the legalese side of it. There's a shorter version, which is 3508EZ. Then there's a longer version, which is really a bear, 3508. The 3508 was originally the only application that was out there, but last Wednesday they came out with the two versions, and we can walk through a little bit of what's going on there. We're not going to spend a whole lot of time on that. We're going to spend most of our time on understanding your cash flow, which is the deep dive number one into the GrowthLab Four.
So what was one of your major learnings from the PPP loan forgiveness application? Because you and the team spent a lot of time putting together videos. We even put a calculator to help you complete the application. What was one of your learnings?
So this was diving into the calculator. We did put together an extensive Excel, call it calculator, really toolkit for you to complete the longer form version of the application. One of the biggest learnings there is that when they're looking at your reduction of wages or your reduction of FTEs, they're looking at, particularly on the wages side, they're looking at that on a person by person basis. So you cannot have, reduce one person's pay or get rid of one person and bump 5 other people up in pay to level set your total wages. They're looking at it on a person by person basis. So if you have had a reduction in one person, you'll be dinged on your forgiveness amount.
But at the end of the day, do they take like the weighted average per person, or so in order to hit that 75-25% reduction in
the 75% is what you need to spend on a payroll. 25% can be spent on other items. Actually now it's 60-40 with the pay checks.
But I'm talking about that reduction. So if you've reduced someone's hourly rate or salary by 25%, does that push you over the top to go into safe harbor mode, or are you still able to figure out what the weighted average, pre versus post?
Right. Yes, you can based on a person by person basis, you can go into safe harbor mode for those people.
So if I've got 40 employees and only one, let's say we reduce their pay by 50% for whatever reason, to save money or new job, right? Does that automatically ding me from being able to just go straight to the finish line?
So two things. One, you can take your reduction, let's call it like $800 or let's call it $1,000 that your forgiveness would be reduced based on that one person's comp. You could either take that and just push it through the application, say my total forgiveness is going to be $1,000 less.
I got it. Okay.
Or I could go into safe harbor mode and say, based on the safe harbor rules, is that person being brought back up to a higher level of comp over the next 8 or 24 weeks before December 31st.
So unless it was systemic and it was maybe just one-off employee that is probably, say, a lower wage, lower salary employee, it probably doesn't even make sense to go into safe harbor mode, because obviously that just opens up a whole other can of worms, and that's
a lot of different calculations and a lot of more info. So our calculator, our toolkit, is available at mygrowthlab.com/loan forgiveness. It's kind of a,
Yeah, John, why don't you put it
careful.
in the chat room?
We can put that in the chat. And it's an extensive Excel workbook. And if you need to use it, there's a video, same page video, kind of walking you through how to use it. Or our team, you can engage our team to help you collect all the information. But as you're going through the forgiveness, make sure you document everything that you're looking at, because it's going to be quite a bit of a bear. And therefore, if you can use the easy formula, we'll walk through the kind of the workflow of that. And that's what I wanted to focus on here. If you can use the easy application, you really should.
So talk to me a little bit also about the 8 versus 24 weeks.
Yeah, 8 weeks is the original. Obviously, the original, you had 8 weeks over which to spend money on applicable things in order to get it forgiven. Now there is, with the the PPP Flex Act now gives you the option to choose to have a 24-week coverage period. Obviously, that makes it much more likely that many more businesses can spend the money on relevant expenses to get the full amount, or as much as possible, to be forgiven.
But it does create risk on the salary reduction.
It does create risk on the salary reduction. If you're kind of level
who knows
set,
what's going to happen in 16 weeks?
if you know you're at your bottom, you expect you're at your bottom, and you're going up, you can have some time to get back up to some call it pre-COVID wage levels. Alternatively, if you've made strategic decisions to do things within 8 weeks, and you expect that after your 8-week period, you might have a further drop in headcount, that's the reason you would choose to continue with the 8-week period.
Right, exactly. So you walked into this program 8 weeks ago, thinking one thing, planning, right? Maybe possibly bringing back some of the team members that you let go, instead of putting them on, say, revenue generating activity, you had them doing some, painting, cleaning up, maintenance, and now all of a sudden the business is not coming back, and it's probably not going to come back until the end of the year. But now you're stuck with no PPP money, and if you do go the whole the rest of the 16 weeks, you might end up dinging yourself on the reduction, because you end up eating up all your PPP money within 10 weeks. So
I mean,
you were like get a game.
Yeah, you've been on the phone with some of our customers today, even kind of walking through this kind of strategically. Which do we use, 8 or 24? Even on the FTE side of things, which we haven't even got into, there's some reductions to your forgiveness that can be impacted if you've had a reduction in FTEs, which again, there's a formula on that side. I won't get into it, but
yeah, this is a crap show.
But what I think we can kind of give you some value on today to help you kind of navigate this. This is something that I have not seen out there, and we've been watching this pretty closely on what people are looking for on Google. The applications are out there. The easy application, the whole first page is taken up by basically what you're seeing here, and this will get you 80% of the way there. If you end up on the easy side, make sure that you read that, and it can all the details, because there's performance periods, etc. But this is essentially your decision chart in terms of if you can go with the easy or if you have to go with the long form.
So this is like right off, hot off the press, right?
Yeah, this is as of last week.
Hey, John, why don't you do me a favor? Can you screenshot this and tag it to the Facebook live feed?
So let me just walk you through this kind of quickly, and then we'll focus on cash. And feel free to ask questions in the chat if you have any questions or issues. And we will be holding our office hours as we do Tuesday through Friday at 3 o'clock every day. Open meeting, open Zoom for you to come and ask questions. But first question is, are you self-employed, independent contractor, or sole proprietor? If the answer to that is yes, go ahead and use the easy form. If the answer is no, ask yourself another question. Did you reduce salaries or hourly rate of pay by more than 25% for any employee?
Any employee.
Any employee.
Not just
on
like
an individual by
average,
person by person basis. If the answer to that is yes, then you got to use the long form. No questions asked.
Good luck.
If the answer is no, then you have to talk about your FTEs. Did you reduce the number of employees or the average number of hours paid? So if you could just ask a person, or you reduced hours, if the answer to that is yes.
Can we pause there for a second?
Sure.
Now, does that allow us to use the 1 versus half FTE? I'm sorry, the 1 and the full FTE or half FTE calculation versus the range of potential FTE, 0 to 1.0.
So what Dan's talking about there is that there are two ways for you to calculate your FTEs in this. And you can calculate it specific to you. 40 hours is full time. So if you have a 32-hour person, 32 divided by 40 gives you their FTE. Or you can do it by that, your exact numbers. Or you can do it, they give you another way to do it, which is if they work 40 hours, it's a 1 FTE. Anything less than 40, if it's 37, 38, you can put that person as 0.5. And the caveat here is that whichever method you choose, you have to choose it for each of the comparison periods. So initially, you've got a comparison period of right before COVID and during your performance period. And then if you go into safe harbor mode on the FTE side, there's actually a few other performance periods that you're measuring against. But the key there is that you have to use the same calculation each time. And there's some nuances there that may make it more advantageous for you to use one versus the other.
Yep. Good. So if I answer no to, I did not reduce my number of employees or did not reduce the average paid number of hours.
So if there's still no, you keep going to the left. And then were you?
If you say yes, you got to jump right to
long form.
So if you did any of those things, you got to go to long form. So no, what's the next step?
Then you have this little bit of a gray, it won't be gray area, but they give you a little bit of an out that says if you were not able to operate at pre-COVID levels during the covered period because of social distancing, etc., then you can still use the easy form. So if you're unable to operate at pre-COVID levels due to social distancing, if the answer is yes, I was unable to do that, then you can go to the easy form. Otherwise, you still have to go to the long.
So in other words, if I were a full service restaurant and I did not bring everybody back, but I brought some people back to manage my takeout business, I wouldn't have to go long form. I wouldn't have to use the long form. I could go right to the easy form.
Right.
Sweet.
So
that is a gray area, right? Because everybody's going to be like, yeah, we couldn't open up because of social distancing.
Yeah. So
good.
We kind of distilled that today for you. And
so one last curveball to Byler. So I hear there's possibly another PPP loan law that might be coming out. There's some talk that if your revenue actually did drop by more than 50% and didn't come back, you may be eligible for another tranche of PPP money.
That I would not be surprised.
I did get you. All right. Anyways, cash is king.
So I'm actually going to jump back here real quick. Review the GrowthLab Four. See, these are the 4 challenges that companies of all sizes are challenged with as they operate. 1, understanding your cash flow. 2,
know where you make and lose money.
Number 3 is marketing for profit, not just driving revenue. And number 4
is paying employees for performance, not just to show up.
Yeah. So these are we call the GrowthLab Four, 4 areas, essentials to your business. Today, we are going to jump into the cash in the next few weeks, and you'll hear us kind of hitting on these in multiple channels on our podcast on Wednesdays, coming out on Thursdays. We're also hitting on these. Last week, we focused on number 3 in the podcast.
We jumped the gun.
We jumped the gun, but for good reason. And we'll be running through these as we go through the next
And
few
this
weeks.
week, we actually have a special guest from Tally Street, experts on cash flow management, cash flow forecasting.
Built right into your general ledger, QuickBooks Online.
Yeah, it's beautiful, right? Because part of understanding your cash flow is you need to be able to implement this, and that's a great little tool that provides you with reports and ongoing support. So,
Yeah, it's straight up into your inbox.
All right, so let's talk about understanding your cash flow. So talk to me a little bit about the challenges there. Why is there a challenge, right? Why does Bob, the small business owner, why does he always get confused between his P&L and his bank account?
Yeah. In businesses, whether it's a small business, whether it's a larger business, it's hard to understand your cash conversion cycle at times. And some businesses, it's
Is it hard, or is it they just don't know what the cash conversion cycle is? They don't think about it from cradle to receivables?
Probably the latter, right? Because usually what's fresh on small business owners' minds, particularly in times like this, is, do I have enough money to cover payroll? Is there enough business coming in the door to keep my people busy, keep them at the table, and keep them paid and keep food on their table? And that's top of mind, right? So they're not thinking about how long does it take me to collect cash, or how much am I laying out in order to be able to put my widgets together, and then which I then go to sell. What's tied up in working capital?
Yeah.
But cash is king, and cash is not your profit. So when your P&L tells you that you're either making or losing money, your bank account may not reflect that because of the cash conversion cycle.
Right.
What do you what's your pitch?
So when I think about cash conversion cycle, I think about from the moment you have to lay out cash in order to ultimately invoice and collect cash, that whole process, that whole journey looks very different based on idiosyncrasies of the business, of the industry. It also looks very different based on the capital structure of the business. And let's not forget the stage in which the life cycle stage of that business, right? So venture-backed versus a small, medium-sized business that's been sort of the flywheel. I always refer to the cash conversion cycle as sort of the flywheel of a business. So let's kind of walk through, which is probably where you're headed.
Yeah, walk us through like a service-based business, right? Like what's that look like?
So a service-based business, chances are you're paying your employees on a weekly basis, right? If you're lucky, you're paying them every 2 weeks, but chances are you're paying them every week. So you can count on 52 times a year, you got to pay that payroll. At the same time, because you're paying that payroll, hopefully your team is actually providing a service, right? Rendering that service to the customer, which ultimately gets invoiced based on your invoicing cycle.
Right. So typically, you have to deliver the service, and then once it's delivered, let's say it's for a week. Once it's delivered for a week, then you can create an invoice and send it to the customer.
So if you're lucky, right? Because then there's also cost benefit analysis, right? It's not just about cash. So you're not going to get sucked into doing invoices every week or every day, right? Because that doesn't make sense. So maybe you're going to make a decision how to best create a system or process that meets the needs of your cash, but without destroying, if you will, contracting your gross margin.
Taking too much time on that.
So let's kind of walk it. So the typical business on a service side would look more like this. I'm going to spend, so from the 1st of the month through the end of the month, I'm going to pay employees either 4 times or 5 times during that month. And that cash is out, right? So you're out that cash. Then by the 15th of the month, you're probably reconciling all of those time cards or whatever way you're capturing value. And by the 15th of the month, you're going crazy invoicing all of your customers. Hopefully you have net 30 days. Or maybe 45 days, depending, right? Or maybe you just have lazy customers that just pay when they want to pay. So now you're going from the 1st to the end of the month, paying all your payroll. You wait 2 more weeks to reconcile all those time cards. Now you're out 45 days by the time you actually get the invoice out, and your average typical customer has a 45 days outstanding, which means normal, it won't be a normal distribution curve, but it will be a log normal where half of those people are paying within the first 45 days and the other half are paying beyond those 45 days. So,
but those two 45-day chunks together gives you
30 plus
90
15
days
plus 45, you're 90 days out. And if you're a $1.2 million company, 90 days out, you're essentially turning your cash every 4 weeks, 4 times a year, right? And that's not good, which means you essentially have $250,000 plus or minus sunk into the business at any given point in time. Now, that's
therefore service-based business, working cap, that is the working capital of the business. So those 90 days, basically you're financing your customers for 3 months so that they can use your service.
Right, because your employees obviously don't want to finance your company. So you got to pay.
And that's illegal, right?
So you now that's a very rough estimate because obviously you're not paying your team members, your employees on the 1st of the month. You're really spreading it out. So if you take the average of the average, those monies are really outstanding 15 days plus the 15 days for invoicing plus the 45 days. So,
but that mindset and just looking at it that way is not what your typical probably small service-based business owner is looking at it.
No,
They're just looking at it as, do I have enough cash? Who can I collect cash from this week to pay payroll next week?
And then you can even take it a second, another step and look at it not just in the total conversion cycle, but what is my cash flow break-even point?
Mm-hmm.
At what day do I actually break even on a cash basis? And it's probably somewhere around 60 days, given that example. The other piece to this is understanding your cash flow is so critical, because that's where you begin to understand as a manager, what are all of my levers that I have available that I can pull to optimize my cash flow, right? Is it sales and marketing, where maybe I take deposits from customers, 50% down, or maybe it's rethinking the whole business model and saying, hey, I'm okay not hitting 70% gross margins. I'm okay hitting 60% gross margins, but to collect the cash up front on the first of the month. So the customer, by the way, back in college, our professors back in the 90s used to always talk about Dell, the Dell cash flow model. The professors would say Dell had a negative days outstanding, right? They actually didn't have any working capital in the business because it was all prepaid by the customer. Because if you remember back in the 90s, you wanted a computer, you either went to Best Buy and got a really crappy computer from Compaq, or you went on to Dell, which was kind of the vogue thing back then. You go onto Dell's catalog and you would pick what computer you want, throw your credit card down, and 30 to 45 days later, you'd get a new laptop. Essentially,
somewhat custom built, right? Like to you.
Besides custom build, you're essentially funding Dell's working capital. But that's kind of a.
So what you're getting into there is going beyond the kind of the understanding, and then you're going to designing and implementing, right? Because you're asking the questions like, how can I change the dynamics of my the flywheel, the cash flywheel, so that I am not standing there 90 days out and just starting to get paid for what I laid out, which is getting paid up front. Whether the SaaS business model, right? You're going to pay at the first of the month, and they're going to pull that money out of your bank account, whether you like it or not. Netflix, right?
And then on the flip side, you think about inventory intensive companies, right? You hear back in the 90s, you heard a lot about just-in-time manufacturing. The purpose of that was to minimize the working capital, impact on the business. Obviously today, after 12 years of free money, right, cost of capital is so low, nobody cares about being a banker to their customers, which, for better or for worse, creates a very sort of slippery slope. I have one customer, I've even brought up to him, hey, maybe we should extend terms to our customers to keep it. And he's just like, I am never going back there again. And I said, Scott, I don't blame you. I wouldn't either. But knowing your cash conversions cycle forces you to understand that is an option out there.
Yep.
And then the last thing is, I'm just going to add, during this whole PPP sort of COVID world we're in, people are going to wake up at the end of the year and say, wow, my P&L says I didn't make a lot of money, but I have a ton of money in my bank account. What they're not realizing is the money that's in your bank account, that is not a P&L effect, right? That is a balance sheet effect. And at some point, especially if you're a passive entity, you're paying, it's like these phantom dollars, right?
Right.
Remember that? Your net operating profit has to be used to pay back those loans on an after-tax basis.
And that's assuming that it stays on your books as a loan.
Right, that's assuming.
Like not getting.
I'm just assuming that there is going to be loans on the books.
Right.
And at some point, your P&L is going to look worse than your checking account, and everybody's going to get cash lazy again. And then we all know what's going to happen after that. So,
but that aside, like talking about PPP monies, right? If you do get it forgiven, those monies are right now going to be recognized on your books as income. And it won't have cost of, you've already paid that cost of goods, right? So this is forgiveness for you putting out those costs of goods for a service business, and therefore your bottom line, your P&L is going to look quite good. But if you're a pass-through entity, you're going to have to pay the piper on the.
So there's a lot of issues that are going to come out of all that again. But let's go to design now, right? So now that we begin to understand the importance of cash flow, right? Understanding that cash flow and accrual accounting ain't the same thing. What's in your bank account isn't always what's in your general ledger. Now you begin to say, okay, well, what do I need to create, right? What do I need to create to better manage my cash? And, there are tools like worst case, your you're on a 13-week cash flow, right? Best case, you're actually planning out liquidity, your liquidity profile of a 3 to 5 year plan, especially if you're in a capital intensive business. So begin to design processes that help you achieve the goals you're trying to achieve.
Right. Because,
by the way, one process is check your damn bank account every day. Which we do, right? Not that we had to, but it's another sort of gut check as to what's happening.
But that's if you understand the dynamics of your business, you understand kind of what numbers should be there, right? So whether you're out, overperforming, out underperforming in terms of what you would expect.
Right. I always have a benchmark,
right.
a plan, right? So I'm looking at it just as a litmus test, right?
And then the tools, that we're looking at to, whether it's 13-week, 12-month, 3-year plan to identify your liquidity needs, then you can take a step back and say, based on the dips and why the dips are there in cash, what monies or what capital is available and appropriate to fill those needs, right? If it's a big capital expenditure that you need to buy a piece of equipment, that's one thing, right? If it's like day-to-day operations and that's eating your cash, that's a different one. You have to solve that in a different way.
Right. So a good example is like if you're in the manufacturing or actually sort of construction industry, you're building up, you win a contract, right? You bring in the sale, you book it, and now you go out and go order your materials from your vendors. And now you're planning out the next 6 weeks to make sure your employees are optimized in the right place at the right time. That is part of your cash flow planning, because that individual, this particular company in mind, understands the delay in sort of from the booking of the sale all the way to the actual collections of that receivable and all of the nuances, the cash in and out that happens between point A and point B. Now you begin to design systems such as inventory control, better vendor order management, management of lead times from vendors, so things aren't just sitting around on the factory floor waiting for your technician to go off and install it. Right. Maybe it's also a better managing and tracking of invoicing, right? Invoicing is actually a big pain for a lot of companies. We talk about, QuickBooks can do it, Xero can do it. It's not that easy. Right? Because invoices are the compilation of a lot of different pass-through expenses, time capturing.
If you don't have systems for all of that, right, it's going to get held up, and it's going to become a bigger and bigger mountain. I mean, we've had customers that haven't invoiced, $400,000 because it just didn't have the time to focus enough to be able to take all that and compile that into an invoice that's understandable to the customer, that the customer can reconcile in their head or on their systems that, yep, that was the value exchange, and I'm going to be ready to pay that.
So you've got understanding the cash flow, right? Understanding what is it and how does it come about? Designing the systems that can give you more visibility and a greater propensity to actually manage and pull the levers that you need to pull. You got to be able to implement it. And one of the easiest things to implement is just simple cash flow planning. Other things to implement is, now that you can see the bigger picture, is thinking about other parts of your value streams, whether it's sales and marketing, credit underwriting, inventory management, vendor management, right? Be able to put that on a value stream mapping, right? And understanding like where each component of the value stream drives or impacts cash. Because at the end of the day, what you're trying to do, which is number 4, is measure. If you can't measure,
can't manage,
right? So understanding, one of my favorites is, because it's so easy, it's just stupid easy, days outstanding. And there's 1,000,001 ways to, everybody's got a better mousetrap on days outstanding. I just think days outstanding is just a great sort of back of the envelope. Hey, it takes on average my customers to pay me, 45 days. On average, 50% of my customers pay me between 30 days and 45 days. Great. Now you can begin to design and optimize systems that reduce your days outstanding.
Tally Street, right?
Tally Street's
on,
great,
on,
right?
on Wednesday.
I'm just going to turn the air conditioner on.
They're tapped into your QuickBooks. They're looking not just at globally, what is your cash, what is your days outstanding, but they look at it on a customer by customer basis. And they do this as your kind of automated FP&A analyst, right? Like we're bringing them on. We've got lots of FP&A analysts around us to help our customers. But we've seen the value of the system. Just as an example, right? It's a tool that you could implement and use to measure your days outstanding.
But the powerful thing there is driving
decision making.
Collections. Collections is such it's a boring sort of low value, no value. Like customers don't get any value from you collecting money, right? But it's so critical to cash.
Right. And so the emails from Tally Street will be like, hey, you should go after these 3 customers because they usually pay you in 40 days, and right now it's 50 days.
Right. And we have a ton of ideas around how to improve collections. We just had one customer asking us to help redesign the whole collections process. Collections for me is all about rigor and cadence, note-taking, follow-up. It's like sales 101, but for collections. The last thing to kind of think about around the measuring, I'm just kind of jumping right here, is actuals to budget. If you've created the systems to plan 13-week cash flows, 12-month cash flows, or longer-term planning, don't just create the plan for the sake of creating the plan, but go back and update it. If you're creating a 13-week cash flow, you should be reconciling that thing every Monday morning, right? There's no reason not to. And then lastly, if you're doing the 12-month budgeting, either on accrual or cash, I always like to start with accrual and then convert it to cash every month, actuals to budget. So I think we're coming into...
Yeah, sorry, I just saw the note that when we touch the table, it makes a loud noise in your ears. Apologies about that. The question about the tool we were talking about, that we're going to have as a guest on Wednesday for the podcast. It's called Tally Street. We can talk more about it in
Tally,
like a tally mark. Tally Street.
What's a tally mark?
1, 2, 3, 4, 5.
Oh,
yeah.
Oh, okay.
How many days have I been in quarantine? Right on the wall. That's what we should put right back there.
No.
So that's cash. I did not have much else on here. We'll go kind of plan to go into the deep dive of 2, 3, and 4 over the next few weeks, pending other things coming down the pipe that make more practical, actionable advice for your business.
Yeah, I think we're probably going to have to spend a little bit more time on the loan forgiveness calculator. Obviously, we've begun to evangelize again, like the worksheet A or Schedule A. You have Table 1s, Table 2s, right? There's a lot there. So we're driving at how to systematize the application, if you will.
Yeah, it's very
help with backup, and so
we'll refine that decision flow and crank that out to our network so you can have that, you can share it, and as we get more information, we'll keep things updated.
Cool.